Hey, accredited investors, I'm excited to announce that we have a new deal right now. It's a 78 unit building, 5 minutes from the Kentucky Derby. Its rents are presently 20% below market for renovated units. To learn more, all you need to do is go to homeinvest.com or click in the description below. Always consult with a tax advisor, financial planner, and/or attorney before making investment decisions. Having said all that, all you need to do to learn more is go to homeinvest.com or click in the description below.
Welcome back to Purpose Driven Passive Profits. His name is Nate Armstrong. He is the CEO and founder of Home Invest. My name is Steve Warner, and I'm the Chief Investment Officer here. If you believe, like Matthew 25 says, in finding a way to be a good steward of your talents, you are in the right place. This show is all about helping you find financial freedom, give back, and impact the world through passive real estate profits. Nate, today we are talking about a document called the PPM. What is the PPM and why is this important to would-be investors? This is probably, arguably, the most important document, if not the second most.
Yeah, okay. PPM stands for Private Placement Memorandum. And in simple terms, it's this: like when someone's investing into a real estate partnership, a syndication, they're actually becoming a partner in the deal. And there has to be paperwork that links their money to that deal. And this is the paperwork that kind of pulls the whole thing together. But it's expanded from a typical partnership. So I'll give you some context on that for everyone that's listening. So a typical partnership is going to have something called an operating agreement. If you go form a limited liability company or any kind of partnership, you're going to need to have some kind of agreement that outlines who does what, who's responsible, how payments are made, how profits are split, how costs are divided, et cetera, et cetera. The PPM is really that, but it's expanded as well. It's expanded because in order to accept investment money from a passive investor, the government, the Securities and Exchange Commission, they have developed a lot of rules around that. And a lot of those rules include things like fee disclosures and then risk disclosures and things like that. So when you're ready, Steve, I'm happy to tear into some of the minute details of it, but that's kind of the PPM as a whole.
So that's what it is. Why is reading it important? Like when somebody gets this document, what should they be looking for in it? Because it's usually pretty dense and it's something that they need to know how to read.
Yeah. So here's what I do. Like if I'm getting someone else's PPM, and I'll talk about ours and other people's as well. But when I'm getting someone else's PPM, I go straight for the summary and I want to read the high level summary. I want to know how they're getting paid, and I want to know the relationships between them and maybe their other entities. If there's third-party property management, or if they're paying their sister or brother for services. I want to know those kinds of things. And usually the summary page helps outline that really, really fast. So I'm going to start with the summary. And then if there's something in the summary that stands out to me, then I'll use that as a clue to where I can find the detail of it in the PPM itself. So why should people read it? Because it's literally everything to do with the deal, and all the disclosures and all the fee disclosures are written into a PPM. Now, here's the reality, Steve. 95% of people, when they're making an investment, whether it's with Fidelity, Northwestern Mutual, or any of the big companies, usually no one reads the PPM. No one reads the risk disclosures. No one reads that stuff because typically, especially if it's an online platform where you're coming in and kind of doing the signing, usually it's in a click wrap agreement, meaning that little tiny box at the bottom of a bunch of fine print that says, I accept these terms and conditions. Most people never read the terms and conditions. I mean, Steve, have you ever read your credit card agreement before? I don't mean to put you on the spot, but I mean, has anyone?
I will say that I skimmed it. I probably read more than I should, or more than most people, but not as much as I should. There are times that I have done exactly what you're talking about. And that, you know what, like, I'm not going to read all of it. I know that I'm in for it. I'm buying this thing. When I bought my iPhone, this is one of the things, like you have that agreement. You're just like scroll, checkbox, scroll, agree. That's it. Right. I trust it. I'm moving forward, and that's how it happens. So my question is, if that's how most people are doing it, and let's just be honest, even if they're sitting here, that's what's going to end up happening when this happens. What are the one or two things? We talked about going to the summary. We talked about looking at fees. So we are going to be covering fees in a separate podcast. We're going to go through the 6 different fees that somebody can charge during a syndication. We'll talk about what the averages are and what you should be looking at there. So they should look at the executive summary, the entities that are involved, the fees that are charged. Is there anything else that they should absolutely just make sure to at least skim before signing this agreement?
Yeah, there is. There's one really important, and it's not even the agreement itself. It's the whoever the sponsors of the deal are. That'll be outlined in the PPM most certainly. But most people, before they even get the PPM, they know who the sponsors of the deal are. Sometimes when you start looking at deals, they come from like a broker or someone else that's in the middle. And it's my preference to really like go direct, like really know who the people that are operating the deal are, know them at least on some kind of level where you've seen some of their track record, you've seen some of their success, et cetera. It's interesting, like my favorite person ever in real estate is this hedge fund manager that I got to do probably 250 properties with. Just from a professionalism standpoint, he once said, Nate, we're going to do agreements, we're going to sign these things, but at the end of the day, my word means more to me than any piece of paper. And he made that true. Like literally, like whenever deals would get tough or whatever, we'd go back to the word that was spoken. And as long as that word was spoken, like that was the law for him. And I think that that's the kind of relationship or the kind of attitude that you want from your operator, whoever put this deal together, the deal manager or whatever you want to call them. You want to know that they're going to do whatever is right, no matter what, regardless of what the paperwork says. The paperwork is definitely an important part, but you want to know that the operator is just going to do right by you no matter what. So I'd want to know the deal sponsor at a very close relationship level.
Awesome. All right. Is there anything else that people should pay attention to with the PPM? I mean, once it's signed, once the PPM is signed, is it a done deal? Is it locked?
Yeah. It's a legal binding contract. So I'll tell you the scary spots in the PPM. Like the reason it's so much more scary than like Northwestern Mutual's agreement that you just click and you never actually read is because usually a real estate syndication, the PPM is delivered through DocuSign or some electronic platform, but it's usually in full contract form. It's not like hidden in fine print. And frankly speaking, I'd rather that it's not hidden in fine print. And it outlines, this is a law from the Securities Exchange Commission, that all of the risks must be outlined. So like risks like, hey, real estate could go down in value. Hey, rents could drop. Hey, renters might not rent. Like it has to list every single possible risk that the operator is aware of. It has to be printed in plain terms. So sometimes people will get that PPM and they're like, holy cow, this is scary. The reality is if you went through your Northwestern Mutual agreement, or if you went through your Fidelity agreement for any other alternative investments, they have the same disclosures. They're just pounded into little tiny fine print. So a PPM kind of is what it is. They're typically only open to accredited investors. And for that reason, that's why the SEC says that wealthier people, they can handle investments like this. Typically it's just kind of the way that it is. So that's why when you're reading a PPM, I would look for the summary page. I would look at the risks. I'd scan those. I'd look at the fees. I'd scan those. And I would look at who the sponsors are. That's my most important 3.
Awesome. Well, that is what the PPM is. Why it's important, what you should be paying attention to. I know a lot of us, like, we just want to invest our money. We want to know that it's going somewhere safe. We know that we trust the person. Otherwise, we would have never even agreed to it. But here's what you need to pay attention to. You can go back and listen to this show again. It's going to make you safe. It's going to help you find a good investment, and it's going to help you feel secure in it, right? That's what's important at the end of the day.
Got it, man. You got it.
Awesome.
Yeah. At the end of the day, look at the track record of the operator, like the contracts and all that kind of stuff set aside, just like my favorite person in real estate. his word was more important than anything else. And I think that that's the same integrity level that sponsors should have. And it's certainly what we aim for here as well.
Awesome. All right. Till next time, remember to always be safe with your investments. Guard them. Make sure you're investing with people that you trust, and read your documents. We'll see you next time on Purpose-Driven Passive Profits, when we dive into the fees that syndicators charge and what you should be paying in those fees. We'll see you then. Thanks so much for listening to our show today. Here's Nate with our latest offering.
Oh, so I'm excited to announce this. We've got a 78-unit building, multifamily property. It's 5 minutes from the Kentucky Derby. Its rents are presently 20% below market for renovated units. To learn more, all you need to do is go to homeinvest.com or click in the description below.